Liquidity ratio. Liquidity ratio aims to determine the ability of a business to meet its final obligations during short-term period. Liquidity of a company can be analyzed in multiple ways. In current ratio, quick ratio, absolute liquid ratio, or cash ratio. Current ratio. Current ratio is also known to be banker's ratio or working capital ratio. Basically, it talks about the relationship between current assets and current liabilities. Current ratio is equals current assets divided by current liabilities. If current ratio is less than 1, then it indicates the company may not be able to meet its short-term obligation on time. If current ratio is more than 1, then the company has enough money or capital to pay back its debts. Scenario. We'll understand the importance of current ratio with 3 simple examples. Case 1. In case 1, current assets is 50% more than current liabilities. So it means 1000 divided by 500 will get 2:1. So we have enough current assets to pay back our liabilities. In case 2, current assets equals current liabilities. It means to pay the current liabilities, all the current assets are to be sold. So we are left with none. In case 3, there is lesser. Current assets is 100 rupees less than current liabilities. So it is a risky one. Anything more than 1 is considered as safest for the company because we have enough current assets to pay back our current liabilities. But most of the banks prefer to keep their current ratio in 1.33:1. Quick ratio. It is also known to be asset test ratio. It is given by a formula: current assets minus stock divided by current liabilities. When we remove stock from current assets, we'll arrive liquid assets or quick assets. It indicates the most liquid assets of the company. Absolute liquidity ratio. It helps to calculate the actual liquidity, and for that inventory and receivables are excluded from current assets. For a better way of liquidity, some assets are excluded and may not represent current cash flow. It is given by a formula: cash plus marketable securities plus debtors and receivables divided by current liabilities. The ideal ratio is 1:2. Cash ratio. Cash ratio is calculated when a company is going under some financial trouble. Cash ratio is given with a formula: cash ratio equals cash in hand plus bank plus marketable securities or short-term securities divided by current liabilities. If the cash ratio is higher, then it is considered as underutilization of funds. Means the company is not diverting its cash for the growth or development of its business. If it is low, then it simply means it is under the risk of payment of its debt.